and welcome to another episode of Smart Money Millionaire. I'm Wes Cohan, Certified Financial Planner, and today, oh yes, today we've got a good one for you. We want to talk about where to spend your money. Specifically, we want to walk you through a simple 5-step process that will help you be smarter with your dough so that you can build your very own financial plan. So really the question that we want to answer today is, assuming you have leftover money at the end of each month after paying all of your bills, where is the smartest place to put it? Should you put it in the bank? Should you buy new tires for your car? Should you start a new career as a sugar daddy? Well, assuming your long-term goals include true financial stability and true financial independence, consider the following 5 steps. Step number 1, pay off high interest rate debt. Now, in this interest rate environment, let's call high interest anything over 8% a year. So this would definitely include things like credit card debt, subprime auto loans, personal loans, and some student loans. It would not include things like a 30-year fixed mortgage at 4% or an auto loan at 2 or 3%. Now, I was surprised to learn that many people, including many of my clients, don't even know what interest rate they're paying on their debt. So if you don't know, you should check a recent statement or you should call and ask your lender. So it's super important to understand that paying off a credit card at, let's say, 22% interest is mathematically equivalent to earning 22% in the stock market. So the big difference is, in the case of paying off credit card debt, this is far and away the best risk-free return you can possibly get on your money. Paying off credit card debt is guaranteed and risk-free return because you know 100% if you pay off the credit card debt, you're going to avoid that corresponding interest payment. So compare that to trying to earn money in the stock market. Remember, the long-term average of the S&P 500 is about 10% a year. So if you wanted to earn 22% in the stock market, you would need to take a substantial amount of risk. But perhaps more importantly, when we think about life habits, if you're consistently paying high interest rate debt payments month after month after month, you're essentially guaranteeing that you'll be digging yourself into a mountain of debt and you'll probably stay broke forever. Feels bad, man. Okay, step 1.5. Oh, that's right. We've got a bonus step for you today. And what is it? Step 1.5, please like, share, subscribe, and show this channel some love. Boom! Gotcha with that one. Snuck that in there on you, but seriously, I would truly appreciate if you could show me and the channel a little bit of love. Okay, step number 2, establish an emergency reserve. So after you've paid off your high interest rate debt, now it's time to establish an emergency reserve. We also sometimes call this a rainy day fund or a slush fund. Basically, you should think about it as a pile of money equal to 6 to 12 months of your non-discretionary living expenses. You want to park this bucket of money somewhere like a high-yield bank account or a certificate of deposit or a CD, somewhere where it's going to earn 1 to 2% while it's sitting there very safe and very liquid. So when you're trying to calculate how much to set aside in your emergency reserve, make sure you understand that non-discretionary really means your core living expenses that you cannot skip and you cannot live without. So that would include things like your rent payment, basic food, your electricity payment, and of course, your daily Starbucks grande, triple shot, sugar-free, light ice, vanilla latte with soy milk. Well, maybe one of those you could live without, probably electricity. Anyway, in a rough ballpark, your emergency reserve should be somewhere between $10,000 and $50,000. So let me help you give some context to that. If you're a young single person living in Iowa and you're renting a one-bedroom apartment for $1,000 a month, your emergency reserve should probably be closer to $10,000. On the other end of the spectrum, if you're a 50-year-old sole breadwinner of a family of 5 and you live in Southern California paying $6,000 a month for your mortgage payment, you should probably be closer to $50,000 in your emergency reserve. And in fact, I have some clients that are making over $1 million a year and their emergency reserve is in the 6 figures. So it really scales just depending on how much does it cost for you to survive at your current standard of living. So it's important to understand that the reason that we want an emergency reserve is that it protects you if it really hits the fan and you get seriously injured, or you get really sick, or you get whacked with an unexpected expense like needing a new car or needing a new roof on your house. If you have this money already set aside and earmarked, then you're good to go. You can handle whatever life throws at you. If you don't have your emergency reserve in place, you could be in a very difficult situation where you need to borrow from friends or family, or worse, you need to go into credit card debt just to survive. So really the purpose of the emergency reserve is to help you avoid stepping on any financial landmines that could seriously derail your financial plan. Step 3 is max out your retirement accounts. So after you've paid off your high interest rate debt and you've established your emergency reserve, you should think about maxing out your retirement accounts. So for most of you, that would be something like a 401k or a 403b through your employer. Or if your employer doesn't offer that, then it would be maxing out an IRA, either traditional or Roth. So it's important to understand that the IRS sets annual limits on how much you can contribute to your retirement account. So the reason that the IRS is putting these limits on how much you can contribute is because retirement accounts have super valuable tax benefits that are frankly straight banging. For example, with a traditional IRA, you receive a tax deduction for every contribution, and your account will grow tax deferred. With a Roth IRA, you don't get the tax deduction, but you have more liquidity, and your gains are 100% tax-free. With a 401k, a common perk is known as an employer match, which basically represents free money from your employer the more you contribute to your 401k. So some of the nuances here can get fairly technical and beyond the scope of this video, but I'll make it super simple for you. You want these perks, you want to save money on taxes, you want to save for retirement, you want free money from your employer, so do your best to max out your retirement accounts. Step 4, protecting your wealth. So by the time you get to step 4, you are pretty far down the path of reaching your long-term financial goals. By this point, you've made some serious sacrifices to get here, so now it's time to think about how can you protect yourself so that you can avoid some of the biggest monkey wrenches that can really muck up your financial plan.
If you can dodge a wrench, you can dodge a ball. What?
So 3 of the most common ways to protect your wealth are buying different forms of insurances, forming estate documents or other legal documents, or finding ways to shield liability or silo assets. So there's a lot of ways to protect your wealth, and frankly, you don't need all of them. Since we're focused on being really smart with your money, we like to tell clients that think about what are the biggest financial risks to your plan and start addressing those first. So let's give you a few examples here. If you're a 30-year-old married couple with young children, you should probably be thinking about how do you protect your spouse or your young children if you unexpectedly kick the bucket. So the solution here is probably exploring some cheap term life insurance. So there's a bucket of money there to provide for the family, and also establishing your basic estate documents that will, among other things, outline guardianship of who would take care of your orphan children. Example number 2, let's say you're a 40-year-old sole breadwinner who's making $400,000 and you have a $1 million rental property. In this case, you should probably think about disability insurance to protect your big income, and you should think about an umbrella policy or establishing an LLC or limited liability company to protect and shield you from the liability in your $1 million rental property. Example number 3, if you're a 55-year-old single woman and you have a family history of Alzheimer's, you should seriously consider long-term care insurance so that you know you can be protected in the later years of life, especially if you don't have a spouse or children who can help take care of you. Example number 4, let's say most of your wealth is tied up in the equity of the home that you live in, and you live in Southern California. Well, you should probably explore earthquake insurance to protect your house because earthquakes are common in California.
We must protect this house! Will you protect this house? I will!
So really, again, there's no one-size-fits-all here. It's about thinking about your life and trying to understand and anticipate what are your biggest risks and how can you protect them. Should you be protecting your income? Should you be protecting your assets? Should you be protecting if you live too long? Should you be protecting if you die too young? Those are the sorts of questions to ask yourself to figure out what you should be protecting first. Step 5 is what I like to call the gravy train. Choo-choo! By the time you've made it this far, you are really kicking butt. You've paid off your high interest rate debt. You've established an emergency reserve. You're maxing out your retirement accounts, and you've protected against some of your biggest financial risks. At this point, you are truly on a gravy train with biscuit wheels, my friend. Yeah, boy! So in step 5, you've really entered an area of flexibility and luxury where you have a lot of options to spend your money on things that are frankly fun and exciting. So some of your options include things like investing in non-retirement accounts, buying a rental property, starting a business, investing in private equity, or buying some more financial protections. I would also note that the further you get down this 5-step process, the more empowered you will feel to spend your money guilt-free on things that are intangible benefits or that help you live the lifestyle that's most important to you or that just help you have fun. So this can include things like buying a vacation home somewhere in the mountains that you would love to visit on a regular basis. Or maybe doing some meaningful philanthropy and making a difference in your community. Or maybe you just want to buy a Lambo or something fun like that. Again, there's no one-size-fits-all here, but by step 5, you are really doing a great job and you should be proud of yourself. Ultimately, making the right decision will depend on what are your financial goals, what are your intangible goals and the type of life that you want to live, and how fast do you want to get there? Now, I would note that we are all in a different place in our financial lives. Some of you may already be on step 4 or step 5, while others might still be at step 0 trying to figure out how to squeak out some extra money at the end of each month. It doesn't matter so much where you are today in this 5-step process. Really, what's important is that you have long-term goals and you have a plan to get there. I am a firm believer that your money should work for you and not the other way around. So if you learned anything fun or useful today, please show me a little love, like, comment, share, or subscribe. If there's a video topic you want to see in the future, or you have questions about the video today, please let me hear it. And remember, if you're smart with your money and you make good decisions, you're on your way to being a smart money millionaire. Disclaimer, this video is for educational purposes only.